welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing we're going to do is we're going to take a look at how you can find new positions and then how you can manage some of those positions. So we need to find out where we are in the options on the options chain first of all. So if we just pull up, say, something like Apple, that was just Australian dollar futures. We're not going to be looking at futures. So let's say if we pull up something like Apple, we can see here we've got the weeklies and then we've got everything else, which is the monthlies, right? We're going to stay away from the weeklies and we're going to focus on the monthlies. So the next monthly is September 20th, which is 8 days away. That is too close for us, so we're going to go to the next one down, which is October 18th, 36 days away. Now we know we're going to be in a position for about potentially up to 36 days. Could be longer, but around 36 days as a starting point. So then what we do is we pull up our watch list. This watch list can be anything, pre-made one, your own one, doesn't matter. And then what we want to do is we want to filter out everything that has earnings over the next 36 days. So we go over to this filter section and we can filter out everything that has earnings between the next 0 and 36 days. And now what we're left with over here is a list of things that we can trade that does not have earnings over the next 36 days. What we can also do is we can filter and make sure that only things are included that have a 3 or 4 star liquidity level, 4 being the highest. So now we have a list of highly liquid underlyings that don't have earnings, and we can then proceed to the final step, which is listing everything from high Ivy rank to low Ivy rank. Okay, so as you can see here, we've got an Ivy rank of 98.9 at the top, and then right at the bottom 11.1. So now what we want to do is we want to first look at our portfolio, right? This is just an example portfolio, one of our small accounts. Have a look at your portfolio, see what positions have you already got on already. Do you have a lot of airline companies? Do you have a lot of food companies? Do you have a lot of pharmaceutical positions on? Do you have a lot of computer technology type of positions on? Whatever it is, what does your portfolio need? Because if your portfolio doesn't need something, or if it already has too much of something, then it's not a good idea to just keep over cramming it with too much. For example, we've already got an SMH and AMD position in this portfolio. We're not going to go and look at Nvidia, because then that, even AMD and SMH is arguably maybe a bit too correlated. We did have more positions, we've taken some off. At one point it was okay, but you get the point. You want to make sure you're diversified. So make sure you're diversified, go through the list, and kind of see where you're at. So for example, BA here, Boeing. I love trading Boeing, but we've already got UAL, and we did have LUV on. We just closed that out yesterday. So we've had quite a lot of airlines. So we're not going to go with BA, So GLD, we've already got a position on GDXJ, so we probably won't go with that. And you just basically go down the list one by one and see what will work well in your portfolio. So let's just say we find CMG, right? We come across CMG and we think, right, let's look for a position to place on CMG. It has an Ivy rank of 54.6, which is very nice. We go over to the trade tab. We can see here it has earnings on October 29th, which is well beyond the 36 days that we're going to be in this contract, which is perfect. So what we want to do is we want to pull up the options chain for October 18th. And now we can have a look and see where we are. So what we want to do is we want to have a look at this orange bar. This is the expected move. So what this is telling us is that the market thinks over the next 36 days, this is what the expected move is of CMG, which is denoted here plus or minus 3.16. So we want to make sure that we're setting our strikes, we're writing our options contracts further out beyond this orange bar. So I personally like to go with anything between a 15 and 20 delta. There isn't a 15 and 20 delta here based on this strike selection. But what we can do is we can go with the 50 strike, which is a 14 delta on that side, and then we can go with, say, a 26 delta on the call side. Now this is obviously skewed, our delta. This is not a delta neutral trade. However, we can still collect a very nice premium. We're not having to use too much buying power, and we have still got a 68% chance of probability of profit, 83% chance, 85% chance of probability of it hitting 50% profit at some point over the next 36 days. So as we can see, even though it isn't delta neutral, the probabilities are still well within our favor. We can also just drag it out a little bit. It will reduce the amount of premium we collect. It will reduce the amount of buying power required as well. So you can have a little play around with it. But say the 50-60 strikes wouldn't be too bad. If we were to just have a look on the graph here, this was a position that we had on recently, and we have taken the position off. But this is where our strikes were. Just to give you an example. So back to where we were, 50 and 60. That would put our strikes at here, 50, and then 60 would be there, like that, which is almost where the strikes were before on the last position. So there you go. So this is an example of a nice position. We actually did have, as you saw, not this exact position, but a very similar position on, and that's literally how you find positions. By all means, you can just buy along one strike out to just sort of cover your short. It will reduce your buying power required. It will reduce your premium, but because it's such a small underlying anyway, it's only trading at $56. You know, if you want to sell a strangle in it, yeah, it's only going to cost you about $700 in buying power. So I wouldn't recommend covering your shorts. Just keep it as a naked strangle. Enjoy a higher probability of profit, and there you go. And you basically just do that over and over and over again. And one thing you do need to make sure you keep in check is your position sizing. What we've done is there's a link in the bio. If you click on the link, you can click on this free position sizing template. That will then bring you up to this. Just put in your email and we'll send you a free position sizing template. The way that the template works is you put in the size of your portfolio. Let's say if it's $10,000, let's say, and then you enter in the current VIX level. Let's say if it's 19.2. What will then happen is everything underneath will be automatically calculated for you. All you need to do at this point is just use this information to create the backbone of your portfolio. It will tell you how much money to allocate to defined risk positions, undefined risk positions, and how much of your portfolio to allocate to short premium in general. As long as you follow this, you'll be fine. Like I say, just click on the free position sizing template button here. Link will be in the description. You combine that with what we've gone over in the first half of the video and you'll be just fine. So let's have a look at some open positions that we have on currently. So if you go into our Discord and we have a look at some of our live positions. So recently, actually today, we closed a strangle on Australian futures for 18.2% profit. So if we just have a look at that, as we can see here, the Australian dollar futures has a contract multiplier of 100,000, I believe, off the top of my head. Overall, we netted $40 on this position, which is a nice 18% return also on the portfolio. What else have we recently? We've opened a 0DT iron condor today on SPX. We also closed the LUV strangle. As we can see here, banked $21 on that. The LUV strangle came out to a 24.1% profit on that. Let's have a look and see, is there anything else that we did? We closed the CMG strangle for 26.8% profit. A couple of days ago, we rolled the short put up on UAL. We've been doing some daily 0DTE SPX iron condor trades as well. We have recently just started a wins channel as well, where we showcase all of our wins. So yeah, that's how we've been managing some of our positions in this portfolio. By all means, if you guys want to get involved and follow along on some of these trades and some other trades as well, just click the link in the bio. It will bring you to this page here. If you want a free position sizing template, of course, just click on that. It will take you to this page. If you want to get access to our trades and everything, click on EDS Premium. EDS Premium will give you access to all of our portfolios, so you can copy positions we're doing in small and large accounts. You get a full course, so no prior knowledge is needed. We'll teach you everything you need to know. It allows you to earn and learn at the same time. It is a private community in Discord, so you can speak with myself, other like-minded individuals. There is a 100% money back guarantee as well. So if you've studied our full course, followed our trades for 6 months, and you haven't seen results, then we'll work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. We have just launched, so the price right now is super cheap. It's £1 a month. Price will be increasing. Whatever price you pay, that's the price you're locked in at. So you are rewarded for getting in early. If you get in at £1, you will only ever have to pay £1. You don't need to worry about future price increases. So with that in mind, I'll see you guys on the inside.